Okay, so very good morning to you. The As you know that we are doing the topic financial ratios, and this financial ratio, as I explained in the last week, last lecture also, that these are the fundamental or the foundation of your first assignment. And if you notice the first assignment, there are not only one set of ratios, I guess there are four sets of ratios. And the first set of ratio is called operating ratios. By operating means that how well the company operates, and is there any way to judge, to make some assessment if the company's operational performance is increasing or decreasing, or is it constant? And if it is going down, then what could be the reason? Can you spotlight the reason of the downward performance? And if there is some important catalyst which is leading to the improvement in the performance. So all these things, we do this some kind of diagnostic tests. And here, we basically look at the company's operational performance. What are the signs of good performance of the company? So as the name suggests itself, it's an operating ratio. The company operates. Remember that I gave you the concept of the firm, and we have the financing, investing, and what is the connector between the financing and investing is the operations. Okay, so operations are very important. Operations like the usual 9 to 5 or even 3 shifts, 2 shifts, whatever. So those things, how well you do them. And if you're doing something good, is it reflecting on your company's performance? So the first category of ratio the first category of ratio is operating ratio, but the first measure of operating ratio is called operating return on equity. Operating return on equity means that how much return you produce on the equity investment. You know that we have two types of financing in the company. One is the debt capital that we borrow, and the other is the equity capital, where people are the shareholders. So you can also call the equity as the shareholders' equity. Okay? And the book value is why I use the word book value, because the book value reflects that the value comes from the book. And there's only one book, and that is the annual report, the financial statement. There can be the market value of equity also. The market value means how the share prices are trading in the stock exchange, but I'm not considering the market value of the equity. I hope you know that every share has a book value and a market value. The book value is the price in the accounting statements, but the market value could be, in the market. For example, if you buy Nokia share for 10 euros, and that share you bought directly from Nokia. So in the Nokia's books, the book value of the share would be 10 euros. But in 6 months' time, Nokia's shares market value is 400. So then 400 is a market value, but the book value still remains 10 euros. Okay, but here I'm only considering the book value so that we don't go beyond. The purpose of taking the book value is that I don't want that you should go beyond the financial statements given in the annual report book, basically. So the shareholders' book value of equity has some synonyms. As I wrote here, the upper note 2, and then that is called, the explanation is given here, that the book value of equity is also known as net worth or net assets. Okay, why we call them as net assets or net worth is that if your company's book value is 100 euros and you have borrowed 60, so the debt is 60 euros. It means that if you want to repay all the debt, what you're left is 40 euros. So that is a net worth. So if your net worth is positive, It means that your book value of equity is positive. Now imagine a situation. Your company's total value is 100 and the assets, it means the total assets are 100 and your debt is 150. So it means that when you sell all the assets, you would still be falling short of 50 euros to pay the debt because debt is 150 and the book value of the company is 100. So even you sell this company for 100 euros, you would still be running short of 50 euros. It means that the net worth or net assets are negative 50. It means that the shareholders' equity has no value. On the contrary, it's a negative value. Okay, so the one good sign which a company must have is that their book value of assets or net worth, aka net assets, they all should be positive. And how do you get it? Very simple. You can see the straight away the value of the shareholders, equity, or the one formula is that the total assets minus total liabilities is basically. So mark my words, you can see the shareholders' book value of equity straight away in the balance sheet. Okay, but if you are given some kind of puzzle and somebody gives you a value, somebody says that the total assets of the company are 100, total liability is 50, so calculate the book value of equity. Then you should know that the book value of equity is always equal to total assets 100 minus total liabilities 50. Hence, the value would be 50. So you should be knowing it. That first of all, the synonyms that shareholders' book value of equity can also be called as net worth or net assets. And this is calculated like total assets minus total liabilities. And total assets, as you know, we have discussed many times now, includes current and non-current assets, and total liabilities includes current and non-current liabilities. And the definition of current and non-current is based on the time period. Anything which would mature before 365th day is a current, and anything which matures on 365th day and above is a non-current. Okay, the first term is operating profit. Operating profit is the profit which comes from the company's operations, basically. That's why we are more interested in the operating profit. Operating profit can also be called as, because not many companies would write the word operating profit straight away. Most likely, they will not be using the word operating profit, but you have to detect where is the operating profit. Operating profit can be measured by EBIT, this term, earnings before interest and tax. So basically, these are the earnings which are before you deduct the interest and tax. Remember, interest and tax are not the operating things unless you're a bank. Interest is not signifying operation. All the companies borrow, all the companies pay interest, all the companies pay tax. Okay, but the real thing is that, I mean, name a company. Pepsi pays interest and tax. Lufthansa pays interest and tax. Nokia pays interest and tax. But should we include interest and tax when gauging, when watching the company's performance? I would say no, because we are investing or not investing in a company based on its operational performance, just operation. And the best measure, in my opinion, if you want to check any company's operating performance or operational performance, sometimes I use the word, is EBIT, the earnings before interest and tax. Sometimes this is also called as operating income. I mean, instead of profit, they use the word income, okay, which is technically incorrect, but anyways, some companies use. So what can we say? This is operating profit, and sometimes it's called net operating profit as well. Well, these are just the synonyms, just in case you are lost. But one thing I would like to say that sometimes the earnings is also called as income, or sometimes they call it profit. So you can see this phrase also, PBIT, not the EBIT, but the PBIT, which means profit before interest and tax. But if you know what to see and how to see the statement, then it doesn't matter whether it's P or B. So most common expression is the earnings before interest and tax. But sometimes you can see even the income before interest and tax, or operating income, or net operating profit, or just operating profit. Or sometimes you can also see this word profit before interest and tax. Okay, usually these things are calculated already in the income statement. So this figure of operating profit will come from the income statement, and this figure will come from the balance sheet. Okay. Operating profit usually is calculated already, so you don't have to make any calculation. Because if you look at the income statement, you see that there is a revenue, and then there's a cost, and then you find the operating profit. So, but just in case you have to calculate, then the formula is the revenue and minus cost of goods sold. Basically, the cost of goods sold could be the cost of raw material, labor, or the other expenses. And we also subtract the depreciation and amortization. Depreciation is when you're using some fixed assets, there is a wear and tear, and that loss in the value is called depreciation. Like I gave you example of a car, that you buy a car, over the time the value is reducing, and that is called depreciation. And why the value is going down? Because you are making usage of the car, and there is a wear and tear, and because of that, the value goes down. Amortization is basically nothing different from depreciation, but amortization is basically on the intangible assets. Depreciation is on the tangible assets, and the amortization is on the intangible asset. For example, if you buy a software, and the software has a life. So for example, you buy the software for 1,000 euros, and this software has a lifespan of 4 years. So it means that on an average, the software is losing its value 250, 250, 250, 250. So by the end of 4th year, the value of the software is 0. Okay, but then you will not call it depreciation. You will call it amortization, because it occurred on an intangible asset. Okay, so the good news is that both numerator and the denominator values. The numerator come from the income statement. The denominator come from the balance sheet. These values will be given to you. Okay, the only puzzle can be that these words may not be used. So some other expression. In that case, I have tried my best to give the synonyms of this term here, and also the synonyms of the denominator here. But there can be some more terms. But once again, don't get lost in the translation. As long as you know, as long as you understand the logic of those statements, then it doesn't matter which word is used. But in case you have a trouble, you have a confusion, time and again I have been saying that contact me and my colleague, and get the results. And as I said today that I would be finishing at 8:45 today. I would leave, and then you can ask Seher that if you are missing these words. But very quickly, I want to calculate this ratio in the case of my case company, which is BP. So for some time, I'm ignoring it, the slide, and I'm going to take you to the BP's website. I already have the income statement. And remember that the operating profit come from the income statement of the BP. And the operating profit, as you can see, look, I wrote in the slide that operating profit is basically your earnings before interest and tax. So I use the word EBIT. But my dear company accountants are using the phrase, oh, sorry, I think I didn't share the screen with you. I hope you can see it now. Very quickly, I repeat what I just said. I take you to the income statement of BP. And as you can see that, and I told you that the numerator is operating profit, and operating profit come from the income statement. And I use income statement here, the phrase I am looking from the income statement, but operating profit may not be written as such. Operating profit is like saying that, if I say that operating profit is like saying somebody that he is a human being, but he must be having a name. And the name could be earnings before interest and tax, or profit before interest and tax, as you can see here. If I try to do some annotation, so you can see this is the profit before interest and tax. So basically, this is your operating profit, EBIT. EBIT is your operating profit. EBIT can also, EBIT means the first word is E, earnings, but it can also be the profit. So EBIT or PBIT is same. So for this company, it's $11,706 million in 2019. This company has earned. So this is the numerator. And then the bottom would be called the shareholders' equity, shareholders' book value of equity, or we can call it net assets or net worth. And we find this denominator in the balance sheet. So let's go to the balance sheet. Usually, you can see that the equity, the total equity is here. It's calculated already. 107.08 million dollars is the total equity of the British Petroleum. And the synonym of total equity is also called net assets. And look, they also calculate net assets, 107.08, which is same as this. But remember that your company may not be using exactly the same terminology, but as long as you understand the concept, it shouldn't be a problem. And net assets or net worth is equal to total assets minus total liabilities also. So you want to try to see the total assets minus total liabilities, that will also be equal to 107.08. So you can see that the company's total assets are 295,194, and the total assets include current and non-current assets. These are the current assets, and these are the non-current assets. And same way, total liabilities are also called the current, include the current liabilities and the non-current liabilities. So if you have the total assets 295,194, and you subtract total liabilities, which is 194,486, this figure minus this figure would be this, which is net worth or net assets or shareholders' book value of equity. But usually the good news, the good thing is that these numbers are already calculated for you. So basically, I had the net income figure was something 11,000 for BP. Where is that? Yeah, it's in the income statement. Something around, no, the operating profit. The operating profit of the company was here, 11,706. So if I divide 11,706 by total equity, something about 100,708. This value or this value, same thing. Then it comes to be about 11%. It means that the shareholders, the company has been so efficient that it is able to give 11% return on the shareholders' equity. 11%. Now I can do the same thing for 2018 also, because I can compare it with the previous year. The same thing. And if this number 11% is more than the previous year, then I can say that the company's operational performance has increased. But if this number is lower than what we calculate for the previous year, then we can say that the company's operational performance has actually gone down. So, but again, since I'm doing as a template, so I'm doing it for 2 years, but you guys will be doing for 5 years. Because 2 years comparison is not enough. Because in 2 years, you can only make one comparison. But in the 5 years, you can make 4 comparisons. So the 4 comparisons are better than 1 comparison. So therefore, you need to do this calculation for the various periods rather. Okay. As you can see in the assignment requirements of the first assignment, that you will be calculating the financial ratios, and there are 4 categories of financial ratios. Today we have started the first category of financial ratio, and within the first category, the first ratio is operating return on equity. Operating means the operating profit. Operating profit has many synonyms. It can be called just operating profit. It can be called as just operating income, or it can be called as earnings before interest and tax. Because all the earnings which are before you pay interest and tax are coming from the company's operations. First of all, you calculate the operating profit, and then you pay interest, and then you pay tax, and then you are left with the profit, the net profit. But I'm not concerned about the net profit of the company. I'm more concerned as a shareholder. If I want to invest in any company, I'm more concerned about how well the company perform, how well the company operate. I'm not concerned about their bank deposits, that how big bank deposit they have. No, I'm concerned about it, how they are turning input to output, how efficiently they're turning input to output, and thus make the profit. So as a shareholder, your first point of investigation should be company's operating profit. And the operating profit come from the income statement, because that's where we calculate all the incomes and gains. And here, you don't have to. So I can see that in my case company, British Petroleum, they are using the word not earnings, but they're using the word profit. So profit before interest and tax. But I know that these are all the incomes of the company. And then these are the operational cost. Like you can see the purchase. Purchase means the raw material, production and the manufacturing expenses. Similar when you buy something, custom duty, etc. That's a part of your operational cost. Then depreciation, depletion, and amortization. Depreciation means the wear and tear of fixed assets. Amortization means the wear and tear of the intangible assets like software, system, process, Depletion means when something spill or something waste, because it's an oil business. So I'm very sure that when you're transferring oil from one destination to the other destination, there would be some oil spillage. So that is the depletion. So that's a loss because of some, when you are shifting oil from the point of exploration to your container, the tankers, and then you are distributing the oil at different places, and then from different places to different gas stations. So there's always some leakage, depletion, spillage. So that's a part of it's a kind of loss. You can minimize it, but you can't remove it forever. If you are transferring, for example, computers, which are well wrapped, they are tangible, I don't think there is a depletion. Maybe they can destroy because some computers can fall, some box can fall while transporting. So every industry, every company, every business has certain, these kind of losses probability. In case of oil or gas, it's even more because it can just evaporate. So all the operating expenses, and when you subtract them, then you have your operating profit here. And usually in the income statement, you have 3 years data, but it's a sad affair that the balance sheet gives you 2 years data. And after we have the operating profit slash earnings before interest and tax slash profit before interest and tax, the different phrases the accountants use, or even operating income, we just saw in one case company right now. And then we divide it by the equity, total equity, which is this. Even though the total, and time and again I'm saying this thing, that even though total equity is given, but this number is derived by subtracting total liabilities from total assets. Okay, 99.99% of cases you will be given total equity. You don't have to do plus minus, but it's not a bad idea to understand that how total equity comes. Total equity comes when you have the total assets and you subtract total liabilities from them, and then you get the total equity. And total equity is also called net worth or net assets. Net assets, very simple, because they are net of, these are the assets net of liabilities. And when you subtract your operating profit by the total equity, that would determine that if you are able to meet the investor's expectation in terms of operating profit. Because in this assignment, you'll be doing it time period analysis. So when you calculate operating profit on equity for 1 year, 2 years, 3 years, 4 years, and 5 years, then you will be able to see a trend. That is it so that you are constantly meeting the expectations of investors, you're making them happy? Or is it so that there's a downward swing, you are going basically down over the time? Or is it so that you are having zigzags, the company is fluctuating, and based on that, you can make some kind of idea. But I leave you with Seher, and maybe Seher can continue with this concept more. So now I recommend you that for the remaining time, you open your company's financial statements. First of all, you double check with Seher that are you even seeing the right statements? Is it the statement which you should see, or you're seeing something else? And first confirm it. And secondly, pick up the information of operating profit and the equity from your financial statements and see if you observe any interesting trend based on 1 year or 2 years data. But okay, I'll leave you with Seher now. And Seher, are you here?
Yes, I'm here.